if you are investing in a 2-year MLD, out of 100 rupees that you give to the issuer, 80 is invested in the debt of the issuer. So assuming 10-11% is the rate of borrowing, 80 over 2 years, 80 to about 89, 90 to about 100. So in 2 years, 80 becomes 100. The remaining 20 rupees is invested in options. Its call options of the market are bought.
Obviously, yeah.
Hence, you get that payoff. Now, as you know, call options, if it goes below the strike price, the value goes to 0. That's the lowest that you can go.
Yeah.
So at worst, even if the market crashes, your 80 becomes 100, so you'll get your 100 back. This is a simple structure. So for an issuer, they need to have two skill sets. They need to, one, of course, be an NBFC of some standing, because ultimately it's 80 rupees is going as a debt. The second is the ability to buy those options and create this structure. There are a few players in the market that do this. So InCred is one, Anand Rathi is one, who are bigger in the high net worth space. Edelweiss or Nuvama is also one more. In the retail space, I believe we are the first ones to try this out.
Folks, welcome to PaisaVaisa. I'm your host Anupam Gupta, B50 on Twitter. And on today's episode, after a long time, quite some time, I'm talking with the wealthtech platform InCred Money. Vijay Kuppa will talk about how you can invest in alternative investments. Vijay, welcome to PaisaVaisa. Thank you so much for doing this for our listeners.
Thank you so much. Thank you for having me here.
I'm surprised that, we're having you here in 2024, whereas your original organization was in existence for quite some time.
That's
So
right.
let's talk about that. Let's talk about your journey, about Oro Wealth and how it became InCred. And then I want to spend some time about the InCred group. All yours.
Sure. So we started Oro Wealth in 2016. It started as a direct mutual fund platform. We were one of the early players in that space. We were one of the early advisors with the RIA license that came on. So at that time, mutual fund AUM used to be 10 lakh crore. And recently, SBI AMC itself crossed 10 lakh crore.
10 lakh
That
crore,
used to be
correct,
size of
yeah.
industry. So
Yeah.
I think we got that call right, especially after when Prime Minister Modi 1 came, we saw retail participation going up in equity markets. Until then, people used to say FIIs drive the market and DIs used to be sellers. So I think that change, we got it right and we started Oro Wealth. Built that business quite nicely. Of course, helped a lot along the way by a lot of macro. Like for example, KYC became online. Earlier, it used to be a lot of forms and a lot of paperwork. So that helped. Your mandates became online, which really helped the SIP book grow. And of course, COVID, the big event, though it was an unfortunate event, but really gave a kicker to this whole wealth-tech industry. So I think a series of events have boosted the space. And then in 2022, we met InCred. InCred has been founded by Mr. Bhupinder Singh, ex-Deutsche Banker. My co-founder at Oro was also ex-Deutsche Bank, so they knew each other. And it was a meeting of minds and we felt that there is something we could do together. And then Oro got acquired by InCred. Just a quick background to InCred. InCred started in 2016 as well. InCred started as InCred with NBFC in the lending space. So they typically do personal loans. They do MSME loans. And they do a lot of education and school financing. That's their space. The second business in 2019, they started InCred Capital. They wanted to diversify, and InCred Capital is in the Insti side of finance, on the investing side. So they have PMS, they have an AIF, they have merchant banking, they have investment banking, equity research, and so on. So very institutional kind of business. They also house InCred Wealth, which is for private wealth management. They had this whole retail piece that was missing as part of their long-term plan. And that's how we came together. So Oro Wealth got acquired by InCred in December 2022 and then got rebranded as InCred Money. And it's been about a year and a half and a fantastic journey together so far.
Yeah, let's introduce InCred Money to our audience. Let's start with what are the licenses you have in terms of regulation, what is your regulatory status, and what services and products that you offer.
So Oro Wealth was a direct mutual fund platform, but InCred Money is something very different. And InCred Money is an alternate investment platform for retail and mass affluent investors. Essentially, these are products that used to be available or are available still now for high net worth individuals, very niche, high ticket size products until recently. What we are trying to do is democratize those products and give them access to a much wider base. So that's what we do. Why we do that? Because some of these products provide good risk-adjusted returns. They provide diversification to user portfolio. And we think that providing such products at lower ticket sizes just boosts the quality of investor portfolio. And which is why it's quite a popular product among HNIs. In fact, globally, alternates form a large part of user portfolios. So we thought that this is a trend that is going to pick up and we kind of started off with that set of products. Yeah. In terms of licenses, we are today a broker. So we are a stock broker. And in fact, this whole space started getting regulated just about a year back. We have the debt segment open, and we are an online bond platform. It's called OBPP. That is a set of licenses that we operate under. It gives us the ability to offer corporate bonds and high yield bonds to our investors, which is our first product. The second product we have is high yield fixed deposits. So when we studied this space, so let me tell you what is the problem or the pain point that users have. Typically, when you look at a user's portfolio, right, it's diversified in the sense that they have a safety bucket, which typically is a fixed deposit or some government scheme, like a post office savings or something. If they want returns, they go into equity markets, right? So they go into equity markets, they get about 12-14% returns, but of course, a lot of volatility in it. So when you're looking at your portfolio, and our target segment is typically people who are in their 30s, early 30s, slightly more digitally savvy, we realized, I mean, this is a personal pain point. And what I realized was when I was looking at it, one part of mine is earning money, but with a lot of volatility. The other part isn't earning much. And it used to keep bothering me, how can I increase it without taking that risk? And that germinated this idea of alternate assets, that then studied the market, realized that bonds are there. And could we just lower the ticket size and offer it? It's also been helped with regulation also moving in this direction. Until 2022, your bonds used to have a minimum face value of 10 lakh, which automatically made it a high net worth individual product. SEBI then brought it down to 1 lakh, so that opened the way for us. Taxation also helped. So if you know, debt mutual funds had superior taxation, which went away in the last budget. So then after that, bonds and debt mutual funds came on par. So automatically it boosts the favoritism towards this. So a lot of these macro factors helped, and that's how these products came. In fixed deposits, we realized that a large portion of market, we're talking about MF market, 50 lakh crores, the deposit market is 4 times bigger than this. And we thought, how can we boost returns over there? Because that's what people are comfortable with. We realized that the opportunity there lies that if we can bring in a lot of small finance banks and other banks who also fall under the RBI ambit, can we offer their deposits on the platform? And that was our second product. So high yield fixed deposits from small finance bank, Bajaj, Shriram, NBFCs on the platform. Again, the space we're occupying is higher returns without taking too much risk. And as you know, for the banks, they're still under the DICGC. So up to 5 lakh, it's the same insurance that you have, whether you're an HDFC or an SBI deposit, or you're in a Shivalik or an Ujjivan bank deposit. So it's the same. So that's what we have offered. That is the second product. The third that we have are market-linked debentures. So this is a very new and nascent category that we're trying to build out. So typically when you invest in markets, the biggest problem that you have is, markets fall and what do you do? How can you prevent that volatility? And therein lie the use case for a market-linked debenture. Typically these are principal protected. Yeah. And what happens in that is that you get the upside without the downside. It looks too good to be true, but that's how this product has been structured. Again, these are all products which are very niche. So a lot of hand-holding, education is required for our user base. So a large part of our team and activity goes into doing this. However, once people understand the product, understand the risks of the product, it finds a lot of takers.
So I'm trying to understand here, like you said, the mutual fund industry itself has grown by leaps and bounds, and mutual funds pretty much satisfy a lot of the initial people's needs. SIP book is like almost at 2 billion, 3 billion. I'm just trying to understand the market for this, because like you say on your website also, the market for this still is HNIs.
Yes.
Right? Because people, there's a difference between a guy who's having a 5,000 rupee SIP and there's an HNI who has a 50 lakh portfolio. I'm just trying to understand, where do these fit? You gave me some idea about how people who are in their 30s, who are tech savvy. I'm just trying to understand the use case for alternatives in my portfolio. If let's assume that I fit in your profile, how does that work?
Got it. So a small anecdote here. So when you go to your favorite restaurant, right, you order a nice appetizer, then you order a sumptuous main course, and then you have a divine dessert, right? So that's your typical pattern. Now I'm sure, I don't know if I'm making you hungry, but typically if you look at it to investment portfolio, your appetizer is like your equity and your F&O that you do. Your main course, which is your core of your portfolio, is your mutual funds. And then for dessert, which adds the last kicker, is where alternates fit in. So typically alternates come in the space where, one, they are very low correlation to your other asset classes. So it's great from diversification point of view. That's one. Second, typically they are higher returns. So they boost the returns of your overall portfolio. That's point number 2. Third, they also provide protection against inflation. Often when you have a fixed income bucket, they really are not able to beat inflation on a post-tax basis. So that provides that third kicker. So if you're a customer, where do alternates fit in? I would say alternates are, they are part of any asset class, right? So they're either an equity alternate or a debt alternate or even a real estate alternate. So when you talk about debt alternate, when you have debt, which is supposed to be a safety bucket, your steady income bucket, your non-volatile bucket. So debt alternates fit in that space, and you could diversify some part of your debt portfolio into these alternates, which provide that kicker. So that is the first use case. When you come to equity alternates, you have got private equity as one of the asset classes. So you could invest in some of them, which really can give you a much higher return than the others. When you look at real estate, now if you want to invest in real estate, typically you need to have a few crores. Only then it makes sense. But if you can do it via REIT, right? Even as low as 10,000 rupees, you can diversify. You can take exposure to commercial real estate, which is not possible in the physical world. So they provide that exposure, which would normally not be possible. So you can think of them as diversifiers. And what pain point is it solving, right? So the pain point that alternates solve is, how can you form a non-volatile, inflation-beating piece of your portfolio without having the angst that you're not making returns of it? So safety should not mean, or non-volatile should not mean no returns, right? So that's what the problem that you're trying to solve.
Yeah. So, like you've said, it's about democratizing products that used to be available to HNIs and ultra HNIs. So the thing is that these products existed, okay? Bonds existed, they've been there for the longest time. FDs have existed, they've been there for the longest time. MLDs or market-linked debentures are probably newer, but I think they've been there since the last bull run. Brokers have been packaging it in some way. So if I've understood this correctly, the products were in the confines of either wealth managers or banks who used to keep this for higher ticket clients, right? Now you've come here with a proposition that you can offer the same products in a lower ticket size for people like, say, who don't have that kind of corpus to invest in. So I want to ask you two questions here on this. One is knowledge. Okay, because you're opening this now to a lot of people who are not even aware that something like this exists. So what is the kind of education that you guys do? And second, is that what is the tech that you bring on board? Remember that for the brokers, it was easy. You bring a bunch of forms, and the HNIs used to sign it, and boom, you're sorted. It would either go into the bank or sit somewhere, and they would not know about it. But for us, now that tech has changed, products have changed, we need more access. Okay, so education, transparency, access. Can you talk about how InCred does this?
So for HNIs, I'll tell you why was it a restricted product. One, larger ticket sizes. So minimum used to be 10 lakh or even a crore, which automatically rules out a large % of the population. I think here regulation has really helped, and even the regulator is realizing that access to debt products is important. So actually corporate bond globally is as popular as mutual funds. In fact, it's a bigger product than the equity market.
Debt is bigger than equity globally.
Globally, correct. But in India, bonds are very abysmally low in terms of percentage and penetration. Fixed deposits are the debt component. So I think somewhere regulators also realize that we need to bring the ticket size down, bring a lot more people so that they enjoy the higher returns without the volatility. So that's been one change that's come in. Second is usually these kind of products have come with a lot of complexity. They come with a lot of jargons, which automatically scare an investor away, right? So what we're trying to do is just demystify some of these things, come up with plain vanilla products and get people comfortable with the concept. Talk a lot about the risk. So if alternates come with a lot of risk, but it's important to understand how those risks are managed or how they're mitigated. And you should, it's also not for a really simple 5,000 rupees SIP investor. You need to be slightly more nuanced to understand it, or you need to trust a good advisor who can help you out with it. I think this is an important thing. The second question in terms of technology. So all these investments, alternates, typically come into your demat. So you can bring your own demat, whatever broker with whom you have opened your depository account, and you can invest. So it's all quite safe, and you can track these investments. In terms of technology and platform, for corporate bonds, we hit into stock exchange. So we hit into BSE and NSE. So that's so it's all regulated, and the systems are evolving, but we have built a tech platform that can take care of that. For the bank deposits, we have integrated with the banks directly, and hence we have their APIs and their SDKs that are integrated within our app, and we are able to offer these products to the customers. So being digital, and if you really want to penetrate, you need to have that level of technology. And I think that's how you're able to really democratize and reach that last user.
Vijay, now let's go into each product that you've got, okay? The bonds, the FDs, the MLDs. So first is, since you're a platform, let's start with the bonds, okay? Who are the issuers? Okay, now that we know that I, as an investor, once I sign up with you, the demat is mine, the bonds will come in the demat. General profile of the issuers, credit rating, tenure, duration, and then obviously the yields.
Right. So in bonds, you have two types of bonds that are offered. One is NBFC bonds and the second is corporate bonds. Typically, every bond comes with a credit rating. Credit rating starts from a AAA and goes all down to D. Now, what is called investment grade rating is until BBB. So AAA, AA, BBB, and it's so on. And BBB plus is investment grade. So we offer only investment grade rating. That's the first. And the second is that these are mostly NBFCs because they're frequent borrowers in the market. They're a lot more familiar with the issuance market and so on. So NBFCs. So some of the example of what we have done is Spandana, Spurti, early salary, FIBE. That's the thing. Kirtana, Finserv, and so on. So these are the bonds that we tend to offer on the platform.
Like 1 year types?
Yeah, so the average tenure is about 18 to 24 months.
Okay.
Because
1.5 to 2 years.
1.5 to 2 years. Because customers are also comfortable with it. And usually one of the risk mitigants that we have, I spoke about the risk, right, is that a shorter tenure has a lower risk. If you get into a 5-10 year paper, a lot of things could change. For business model could change, outlook could change. You have a lot more visibility in short tenure. So 18-24 months is a good sweet spot.
Are they tradable?
So they're all listed, most of them, and you could, but unfortunately there is no liquidity.
Liquidity, correct.
Unlike an equity stock. So liquidity is one of the risks again in this product. And one thing that we have tried offering is that we have like a market maker that helps customers, exit if they want to. Of course, there's a fees for it. We charge a 2% fee like an exit load. So for investors, they should not look at it like a trading product. You should come in thinking that you'll invest for the horizon. However, due to some unfortunate event, if you want to exit earlier, we're happy to provide that. But you should stay the course.
And typically, people who hold till maturity will get the full yield?
They'll get the full returns. That's right.
Yeah. So that is product number one, the high yielding bonds. Okay. Second is the FDs.
Yes.
This is like as standard, as traditional as it can get.
Yes, that's right.
I log on to your platform, choose my FD.
Yes.
Take it, and then that's it. I don't need to have a bank account with a bank.
Yes, so that's the big thing. Typically, you're locked with your bank. So if you have a bank account and you don't want to open too many bank accounts, you have the FDs of that bank only. Here it is, you can buy it off the shelf. It's just like how you shop on an e-commerce platform. You can shop for your FD. Even if it's not a bank that you have an account with, you pay the money through a payment gateway that we have integrated and you're set.
Yeah, and there's no demat for FD. So I'll get a PDF as a certificate? Or
that's right. You'll get a certificate from the bank.
And that's as good as
That's as good as an FD receipt. You could go on to the bank and you can check it out and they'll give you the money at the time of maturity. Okay. So it's all automated. It'll come into your account.
Yeah. The most interesting part is the MLD, the Market-Linked Debentures. Let's talk about that. A, what does it offer? B, how is it structured?
Sure. So normal debentures usually have you pay a principal upfront. You get a series of cash flows, which is the coupon, and you get a principal back at the maturity. This is a normal structure. Now, in a market-linked debenture, most of it is the same, except that instead of getting a fixed coupon, your coupon is dependent on the market. Very simply put, if the market goes up, you get a higher coupon. If the market comes down, you get a lower coupon. As simple as that. So it's linked to an index. Now, this market could be the Nifty 50. It could be GSEC. It could be the currency. Globally, they do a lot of products around what the market is, but in India, most of it is around the Nifty 50. Another interesting feature of this is because of the way it's a debenture, right? So ultimately, you need to get your principal back. Most of these MLDs are principal protected. So which means that irrespective of what the market outcome is, if the market goes below the price at which you entered, you will get your principal back. You'll get your 100 rupees back that you have invested. So that's how market-linked debentures are structured. These also come with a credit rating of the issuer, and hence they are rated. They have the same features of the debenture. However, their outlook is linked to the market, and it could be 1 times the market, it could be 1.5 times the market, and so on. So that's what a market-linked debenture is.
Who are the issuers out here of this?
So there are lots of NBFCs who do it. InCred Finance, which is a group company, they are one of the issuers of this product. What is important here, so let me just tell you how a MLD is structured, right? Essentially what happens is that if you are investing in a 2-year MLD, out of 100 rupees that you give to the issuer, 80 is invested in the debt of the issuer. So assuming 10-11% is the rate of borrowing, 80 over 2 years, 80 to about 89, 90 to about 100. So in 2 years, 80 becomes 100. The remaining 20 rupees is invested in options. It's call options of the market are bought.
Obviously, yeah.
And hence you get that payoff. Now, as you know, call options, if it goes below the strike price, the value goes to 0. That's the lowest that you can go.
Yeah.
So at worst, even if the market crashes, your 80 becomes 100, so you'll get your 100 back. This is a simple structure. So for an issuer, they need to have 2 skill sets. They need to, one, of course, be an NBFC of some standing, because ultimately it's 80 rupees is going as a debt. The second is the ability to buy those options and create this structure. There are a few players in the market that do this. So InCred is one, Anand Rathi is one, who are bigger in the high net worth space. Edelweiss or Novama is also one more. In the retail space, I believe we are the first ones to try this out and see the market adoption, because it's a great product for, so why don't people enter equity markets? I don't think today for investing in mutual funds, it's a awareness issue. I think that is sorted. But people are scared. They're scared of losing money, which is the basic feeling. This is a great product for you to come in, because at worst, you'll get your principal back. At best, you can get market-linked returns. So the use case here that we're trying to see is, can we bring more people into the market, try this out, and then as you get more comfortable, you can evolve into much more bigger products.
Yeah, the question will always be that what's the hidden angle, because you're naturally suspicious of this. I enter this when the market is at the peak at 23,000 and now it's gone to 20,000. Okay, I get my principal back, which is fine. But how do I get my principal back? I mean, it's just that understanding how the product works takes some time. But like you said 80% of that would
80.
be...
Yeah, so 80 goes to 100. So you're taking 2 risks here. One is the credit risk of the issuer. And if the issuer is able to give your money back, you'll get your 100 back on the maturity date. Second is the market risk. So if the market goes up, you make the extra return. So 100 can go to 120 or 150. If the market goes down, you'll get 0 from that 20% of the pie.
Yeah.
But still your 80 gets you your 100 back.
Yeah. What are the costing of all these 3 products, and how do you guys earn your revenue from that? I'm assuming that something like a bond would be straight up commissions, or is there something more?
So we work with the issuers. So it's more like a, you can call it like a issuance fee or a arranger fee that we get, because these NBFCs who are looking, they're also looking to diversify their investor base. They borrow from the bank in the form of term loan. They borrow from the CPCD market, which is the institutional market. They also want to have a retail diversification. So they come to the retail market as well. And we facilitate that through our platform. So essentially, we charge the NBFC a fee. Typically in the range of 1 to 1.5% is the placement fee. And the rate that is quoted on the platform for a particular bond is what the investor gets. So unlike in mutual fund where there is an expense ratio that kind of comes after the, from what is quoted, and then the NAV is calculated, here it is all done in the price. So if it's said that you'll get 12%, you will get 12%. That's the typical fee, 1 to 1.5%.
And for the MLDs and the FDs, there's no cost to me?
No, there's no cost to you. What you get is what you see.
Okay. So do you have like a fixed subscription fee that you charge me as an investor, or is that...
No, there is no fixed subscription fee. That's it. If you are getting 12%. So if I'm doing an NBFC issuance at 12%, I get a fee of about 1% from the NBFC to do that issuance.
Okay.
And for you, it's at 12% on the platform.
Cool. Let's get into the profile of your customers. I mean, you've been doing this now for quite some time, 8 years. What do you see? Like, what are the average ticket sizes? Do they tend to increase over time? And B, you said in the first half of the show that these are typically people who are in their 30s who are comfortable with tech. You just drill down a little bit further so that our audience understands the profile and the ticket sizes that we're talking about when it comes to your product.
Right. So in terms of the profile, because we are a digital platform, being comfortable transacting online and being comfortable, making investments online is a prerequisite for our platform. So you only need to know that much. That is the basic. The second is people come with two ways. One, you could come in as a DIY customer, which means that you can read the offer document, you can read the terms, you can read the rating rationale and all of it, and you can invest. Or you come by an advisor. So we also have that facility where advisors come in and they then help the customer to invest. And advisors are more sophisticated, so they kind of understand these products. So from the profile, the reason I said is 30s is usually then is when you have a small corpus that is built up. So ideal profile is somebody who has a investable surplus of about 15-20 lakh. Who has accumulated certain base and typically has invested in mutual funds, has a bit of stocks and is looking to diversify. So far, we have been focused on the debt side of alternates. So where we are helping the user is that your normal debt instruments don't give you that returns. So you get a safer asset class, slightly higher returns. We're also evaluating, can we do something on the equity side? Because even equity alternates can help the user. So and that's something that will come up.
InCred has got a pretty large portfolio of products like PMS and AIF.
That's right. That's right. Can they come in and do it? Because on the equity side, one thing that we have seen is there's a lot of clamor for IPOs in the retail segment. One, you don't get allocation. That is one part of it. The second is that even if you do, we often find that IPOs come when the markets are high. And there is very little juice left for the retail investor. And quite often he doesn't make a lot of money. So can we find a place where they could invest in some of these products before this thing? Something we're exploring.
What do you think about that? See, when I look at regulation and these kind of products, regulation, so first the products happen and then the regulation follows. I'm talking about platforms that used to sell bonds have now become OBB, the online bond platforms and stuff like that. Fractional real estate, for example, is now
getting regulated.
That's right. So all of that. You think anything will happen on the unlisted market? The unlisted market is just, at one point of time, it did not even exist. Okay, and logically it shouldn't, right? Because these are
private companies.
Exactly.
That's right.
Private going to go public or whatever. But I guess you can't stop something like that because people who are holding those shares need a liquidity event, and if they do not get a liquidity event, that's going to come out in the market.
That's right.
So what do you think is going to happen out
there?
So
I think the way regulations work is that when the market is small, a regulator waits for a little development to happen to figure it out, like a bond market, right? For many years it was around but didn't pick up. 2021, 22 early bond players started coming in, and then a regulator came in and has regulated it. I think regulation really brings a lot of users in. Think mutual fund late 90s.
Yeah,
right?
Yeah, of course.
Till then, it kind of meanders along. Regulation comes, there's a little bit of dissonance, you have to follow the rules, but real base is being built. And then after that, the takeoff happens. So we actually are welcoming a lot of this stuff because even for the retail customer, they may not know a lot, but they know regulator hai, right? And they, at the back of their mind, they feel comfortable. So I think regulation really will take it to the next level, like even in the fractional real estate market. Higher ticket sizes, but now with the new regulation and coming under REIT, it becomes a lot more simpler for mass adoption. So there are a lot of users who don't invest because it's not regulated. I think regulation will come. I think it's just a matter of time even in the unlisted market.
I basically look at just three things: listed, regulated, rated. If these three things are there, then I feel comfortable that someone's got my back.
That's right.
Otherwise, these the flip side I always think of all this eKYC is also that you'll end up investing in stuff that you don't understand just because you want that extra 1-2% more on your portfolio.
That's right.
I think that should not be for starting, for people who are just starting their journey.
Right.
Their
investment journey, right? They should start with mutual funds. That's a basic thing. Start with an SIP, build a corpus. At some time, you look at your portfolio, right? So one of the pain points in 30s is that you start thinking, how much money have I made? What's my wealth? Until then, it's not really a concern. And then you look at it and you start diversifying, you start saving a little more. You have a kid, you start planning for their education, your expenses. So when people become slightly more serious about their money is when they start, these products may be coming in. For someone in their early 20s, looking to just start. In fact, if you look at the numbers, I think starting itself is like a huge thing. You just need to begin, and after that, it just kicks on.
Talking of which, what plans further? Let's wind up on that.
So plans are, one, we think that alternate is a nice niche area to start with, though we are a broker, and at some time we'll get into more standard broking products because we are doing the KYC like a broker. We're also going to add our own depository that you can open a demat if you don't have it. I think big picture India, very low penetration of financial products still, maybe 20-25% done, long way to go. We've had now a stable government. Hopefully now that will continue. And with that, I think it's India's last decade has been great for wealthtech. I think next decade also is like you can build a big business. That being the path, for us, reach a certain stage, solve a lot of this pain point for users, and take it from there. Idea is, so I even, 8 years back when we started Uro, the thought was, can we get people to invest in mutual funds, right? So that used to be a big thing, mutual funds at that time. Today, mutual funds is very common, and we could never guess mutual funds Sahi Hai campaign and the way it has really captured imagination, right? I think the next 5 years is going to be a bond, 5 year or bond decade. A lot of retail people understand the value of what fixed income brings in. I see a transition away from more traditional PSU bank deposits to some of these products. Regulation coming in is going to provide that ring fence of the protection. And alternates will no longer be that. They'll start becoming a lot more mainstream. And as GDP increases, GDP per capita increases, money starts coming in people's hand, savings will get channelized towards investment. So I think great opportunity, both as a person building in the space, and I think a great opportunity for even investors to start boosting their returns.
So folks, the product is InCred Money, INCRED Check out the website. These are alternatives like Vijay had said, and he's gone through a lot of detail to explain to you the kind of investor, the kind of risks that are there in these kind of products. So please read all disclaimers, and you have a team which can explain and literally walk people in how. So please do all of that before you think of investing your money. Standard disclaimers apply. Vijay, that's it. And finally, our standard question: what book are you reading, or any content recommendations for our audience out there?
So actually I like fiction.
And nice. I don't get fiction people very often, by the way. I usually get...
I like to read fiction because for me reading is fun and pleasurable when the little time that I do get. So right now I'm reading Alistair MacLean.
Oh my, which one?
Puppet on the Chain.
Oh wow, classics, man. Really?
And very good.
Did you read that first in school, college or somewhere?
No. I mean, not.
Was the first time you're reading an Alistair MacLean?
No, I've read a few of them. This is like a rerun. So I've seen a lot of the movies actually. Ice Station Zebra and a lot of them.
Wow.
And the other thing is I love sports, so I like reading autobiographies. So I last read Open by Andre Agassi.
Of course.
And I've read
Djokovic's.
Yes, that one. Now next is Rafa is lined up. Because it's very inspiring, the way they think, the way they train. It's
interesting that he chose tennis. Could have chosen any sport.
So actually, I don't know. They tend to write autobiographies, I guess. So next one is Mamba Mentality, Kobe Bryant.
Of course,
that's some of them. So I think these two I do. I mean, it's personal taste, I guess. Fiction and.
I would love to take a photo of your bookshelf.
Definitely.
Seriously. Anything else?
Nothing. This is some of the stuff I'm reading.
That's a lot to deal with anyway for our audience out there. But folks, that is it. That is a wrap on this episode of PaisaVaisa. Vijay, thank you so much for doing this.
Thank you. Thank you so much. Thank you.
IVM